What's up, YouTube? It's Joe Catchpaulia sitting on the couch making some money investing in fractional real estate online, as usual. Today I was watching a video from another YouTuber. His name's Coach Carson. He talks a lot about real estate investing. Despite the fact that I've been investing for 20 years, I feel like there's always more than I can learn. I like his videos. I think he's actually, he's got a lot of thoughts that are geared mostly towards newer investors. But I think that sometimes hearing certain thoughts from other people who have experience either reminds or reinforces or helps me think of things in a little bit different way than I have in a long time. And so today he was talking about, the sources of profit in his real estate investments, and he's actually tracked this over time. And I thought this was really interesting. One thing he's ignoring the tax advantages, and I think it kind of makes sense because the way, you look at numbers, the tax advantages are really more of a savings. But so he broke it down into this, right? Into price growth, into debt pay down, and into cash flow, right? Those are the three sources of profit in real estate investing. And over, I think he said he's been investing for 15 or 17, maybe 17 years, something like that. And over that period of time, 67% of his profits have come from price growth. Only 14% came from debt pay down, and only 19% came from cash flow. And he's somebody who, the properties that he's doing seem like they have decent cash on cash returns. And this, I think this surprises a lot of people because a lot of people think when you invest in real estate, you should be investing for cash flow. I think that came very strongly from like all the Rich Dad Poor Dad books, and that created this sort of movement. Bigger Pockets got really big into it, and especially after the 2008 crash, where people were terrified that property values were or properties were never going to appreciate again. There became a much stronger emphasis on cash flow. Um, but over the 20 years that I've been investing in real estate, I haven't tracked it, but whenever I've looked at individual deals, it's been very similar to this, and sometimes even more of the income, even higher than 67% has come from price appreciation or price growth. And so one of the things a lot of people are like, oh well, appreciation is gambling, and cash flow is knowing, appreciation is gambling. I think it's completely false, right? And so I'm going to talk about one where the sources of your price appreciation come from, but also why I think that on the right fractional real estate investing sites, we actually have a significant advantage in this area than we do when buying properties in the real world. And so the three sources are market appreciation, forced appreciation, and buying at a discount, right? All those seem super simple, but there's definitely nuance in each that when we look at the right types of fractional real estate investing sites, we get a real advantage. And so, what do I mean by the right types? In general, it means ones that have a robust secondary market. So at the moment, that really is only lofty, right? I mean, um, at least that I'm on, right? Arc 7 is one that I keep going back to that also has this secondary market. But their market maker is just people listing, bids and asks. And for whatever reason, I have never yet seen anything at a big enough discount, or even, big enough discount or premium to make me believe that you're getting the same effects here as you are on Lofty at the moment. Uh, Most of the sites, like Mogul talks about, they're going to have a secondary market at some point in time. Although, based on some comments that they've made, I don't know that it will have this, a robust market pricing feature like we see on Lofty. And I think there's good and bad for that. I think that from a typical user's perspective, not seeing your token price shoot up or down 15% in any given day is probably a good thing, right? Like having a more stable price. But for people like us that are really just trying to profit off of, some additional, benefits of this secondary market, it might end up not being as great for us. But anyway, I'm going to get into it a little bit. The first benefit you actually get across any of them. So when we think about market appreciation, This is you can think of it as passive appreciation is what I think he calls it. And it's really just like that, that home is just going to go up regardless, no matter what, right? Like it's going to go up or down based on where it's situated and what happens in that market. And there's nothing that we can do about that. And that is true. I mean, other than picking good markets, right? And that's one of the things that a lot of the platforms talk a lot about. Like Arc 7 is one that talks about it a lot. They have, that they've picked out markets that they expect to appreciate well. But a lot of the platforms, they talk about that, right? And so when you buy properties in real life, you can pick whatever markets you want, but it is a lot of work to switch markets, right? You've got to find a new agent, you've got to find maybe a new lender if you've gone to a different state, new inspectors, maybe learn new things that you're going to have to look for within properties. And so there's building that team and actually making trips there. It's very difficult to invest across a lot of markets if you're investing in whole properties in real life, and it's also difficult to switch markets. I over the last 20 years, I've owned properties in College Station, Texas, in several places in South Jersey, and in the greater San Antonio area, and that's it. And each time it's because it's where I lived at the time, or it was someplace relatively close to where I lived. I do spend a lot of my day helping out of state investors buy here in San Antonio. But the people that are doing that, very few of them are buying in multiple markets, right? They've just identified one market that they're interested in. They contact us, and partially because we have a somewhat of a prepackaged team with a property manager in place and whatnot. But in general, to try to do that in several different markets is difficult, and so it's tough to get diversification. And it's also you might find a market that you think, okay, that's a great market, and you might struggle to build a team. You might not find good contractors there, all sorts of different things. And so, I think all of the platforms you kind of get that advantage. Like on Mogul, I think they're picking good markets. If I were trying to buy in Austin, Houston, Atlanta, Mesa, Arizona, like if I were trying to buy in all those markets, which is all the places I've bought from them already, um, it would have been a tremendous amount of work. And so you get access to markets where and I think it'll be easier to change what markets I'm focused on over time too. So that's one of the main advantages, in every platform pretty much gives you that, all the fractional sites, although some of them are really concentrated in just a few places, which so okay, you lose out in there. And the next one, forced appreciation. If you're buying properties in real life, that usually means I'm doing a renovation, I'm adding square footage, maybe I'm changing the use of the property. Maybe it's there may be a commercial space that I'm converting to residential, or vice versa, or I'm adding some storage space. Um, you can do that when you're buying properties in real life, and there's a lot of examples, of some of the co-owners doing that on properties that we can buy on Lofty, right? Like, one of the reasons that I like investing in properties that Earl is a co-owner of is he is always looking for, what else can I do with these properties? How can I lower expenses? How can I increase revenue? Like, he's always looking for ways that we can do things. He's looking at, okay, are we going to add a unit in the basement, or is there some other thing that we can do? Um, and so one of the advantages is in doing this on some of these platforms is we don't actually have to do the work, right? If I'm going to buy properties and try to force appreciation in real life, I've got to come up with the plan, and I've got to come up with the team, and I've got to hire people, and make that happen. On all the fractional sites, we can get some of those benefits without us having to do it. We can have a and especially like some of them, um, like Mogul, or some of the ones where the platform's actually also the one running the acquisition and the management. You can have a really professional team running that, and even in on Lofty as well too. You can have some of the co-owners, I think, do a fantastic job. But so that's similar, right? And one of the disadvantages is you can't really get the sweat equity on Lofty or any of the fractional sites that you can get when you're doing it in real life. But that's just one aspect, right? When the other forced appreciation that you can get on Lofty, that you can't get really anywhere else right now, is you can do these, there's little things that we can do to increase the price of the token that's outside of actually, changing the value of the property itself. And so I think the main example that we've seen over and over again is, if it's a property with a lot of trading and the operating reserve builds up pretty quickly, dispersing some of that operating reserve, sending that out to all the co-owners or, all the investors in the tokens, ends up increasing the yield. And every time that I've seen it happen, you see those token prices go up. And so having the ability to do things like that, and, the other things we can do is, um, change the structure of like change the management structure, change the fees that we're paying people. There's other things that you can do that are separate from the property itself that affect the token price, in a way that you just don't see with properties in real life. So that, that's something that you're getting there that you're not getting. And, sometimes it's pretty drastic too. Some of these, this one saw a really big pop once they started paying out the extra reserves, and a lot of them have. This is one that I've owned since I think $52 or somewhere around there, um, and it's one of the few that I have that has gone up considerably. What I'm holding on to, one is it hasn't moved up quite enough yet for me to sell at a profit, but two, somebody it's somebody who I trust to handle this asset in the long run, and it's continuing to pump out a decent yield. And I mean, this yield is at this price. I'm in it cheaper, so mine is even better. And then, oh, the other thing too, like the financing structure. So like on 90 Madison, uh, we are buying some of the we're pay using some of the cash flow to pay down the mortgage and burn those tokens, and so that counteracts some of the dilution effects of the way the mortgages are set up on Lofty. Um, what's really weird is it's actually not helping the token price because I think a lot of people miss it. They just look at the yield and see nothing else. But then, the third thing that Coach Carson had mentioned on here was and he did it in a different order, but the other thing that you can do to really affect your price appreciation is, and it's not appreciation, but it's appreciation from the point that you bought it with, and that is buying at a discount. And this is where, the secondary market is just really required, right? To a certain extent, and I'll explain. So the way you can do it when you're buying real properties and without a secondary market is if, as part of that acquisition, right, the initial acquisition, the property is being bought at a discount in the real world. Sorry about that. I had to close some tabs. My thing froze. But so what I was saying, one of the ways that you can do it on platforms that don't have that secondary market is when you're buying at a discount in the real world. And so, like for example, on Mogul, when I bought the Axelrod property, um, that all the ones on Mogul, they're buying it as we're investing into it. And so, if they're getting a discount in real life, then we're getting a discount. Um, Other than that, though, that ends up being the same way that you would do it if you were buying in real life. But whenever there's this secondary market where we can buy from token holders that are in need of liquidity, that gives us an advantage in when we're buying fractional real estate that we don't see anywhere else. And that's one of the reasons I spend a lot of time on Lofty right now, is you see it here more than anywhere else where we have, just some extremely discounted tokens, sometimes justified, sometimes not. And I think there's a couple of different, you guys hear me talk about buying the discounted tokens all the time. And there's a couple of different things, reasons that this creates an advantage, right? There's a few different ways. So the first one is, um, if that token price is just tanked, right, like we see here. This is what I see a lot, and it's often happening, just because they're very thin markets, and so as people are selling, it doesn't take a whole lot of selling to lower the price quite a bit. Um, this creates opportunities to buy just a few tokens here and there that are pretty cheap. It's tough to get a real big discount on a lot of them, but I've built some relatively decent sized positions in properties, just by continually looking for those discounts. And you don't have to sit here all the time every day. You can set your alerts on here, like I've done. You can also use Lofty Assist, which is, where you can pick specific prices and have alerts set up for those. Um, but in addition to that, so that's one, right, where you're just getting a discount to par value, right? You can also, where we're doing what, I've been calling like the token arbitrage or the token flip, where you're buying the tokens at a discount to the real world value, and so then we just buy it and go and sell in the real world. But then in addition to that, I think there's also, um, without the token price ever going down, there's certainly going to be, and over time, I think we'll see this more and more, where the token prices haven't risen as much as the property has appreciated in the real world. And so we'll get a discount there. And so I think that you'll get that is in addition to already having the ability to um, buy the properties at a discount during the acquisition. We haven't seen that a whole lot on Lofty. I think all the early ones were just true purchases. But it doesn't, based on the performance of those, it doesn't look like anybody was really looking out for trying to get a discount on those, right? They were basically just buying them. I mean, I don't even know how they were pricing them early on. I mean, some of them were ridiculous. I don't know if they just did an appraisal and paid that, or what it was. But lately, most of the properties on here are a co-owner already owns it. They do an appraisal and then they inflate the price a little and sell it on here. But like we just saw Earl go through and buy one where, it's an actual acquisition of a property and he's using Lofty to raise the funds, to go through, or he used Lofty to raise the funds and go through with that purchase. And I think as we see more of those, we'll get more of the benefit, and hopefully, I know that one was a little bumpy, but it was bumpy because of the title company, not because I think they raised their money perfectly quickly. Um, but so as we see more like this, where you're actually, you have the potential of going out and buying that property in the real world and getting that discount, and then maybe in the future getting a discount on the tokens in addition to that. I mean, that's where you start to see this compounding effect, right? And so it each one of those, none of those individually might make up too large of an advantage, although I do think the really discounted tokens is something that you just don't see in the real world. It's very rare to be able to buy a property at 50% of what you could turn around and sell it for immediately. But at the same time, it's only happening on Lofty because it is a very thin market, and so it's not something you can take advantage of with very large sums of money, because as you start to buy those tokens, it pushes the price up. Um, but I think when you add all those things together, your ability to uh, be flexible and pick markets that you think will work better, the ability to, on top of your regular force appreciation, creating some token force appreciation, and then your ability to actually get that token discount, not just the real world discount. All of those together, I think, will just add up. That just compounds, and you can, uh, I mean, I've talked about it quite a bit. Like so far, the level of return I've gotten on here has been kind of ridiculous, but it is also too partially because I still have a pretty small amount of money working on here, because I'm just still experimenting, right? And until so, it'll get nerfed a little bit as I put larger and larger sums on. Um, but I think we'll, continue to take advantage of that. And, just going back to in that forced appreciation, one of the things that I think that we're going to see, we're going to get benefit from this network effect where somebody does something on one property, it really works, and we sort of just, move that to, okay, like, what's the next property we can do that on? Because a lot of us share ownership in a bunch of different properties. And so that's something that you just don't get, in the real world, and gives us a different sort of advantage to be able to really move that price. And that, and back to what I was saying in the beginning. Oh, before I forget, please like and subscribe. Um, and if you haven't already, please join the Discord. There's a link to it in the notes in the description to this video, and also links to all the places I'm currently investing on. Just because I invest in on any of the platforms doesn't mean that you should. I know you guys hear this all the time, but I'm doing it again. And just because I do or don't pick certain properties doesn't mean that that's the right answer for you. We're in different situation. Even though we might co-own a lot of the same properties, you just have to do your own due diligence to make sure it's the right investment for you. Um, Yep, and then I always interrupt myself, and then I forget what I was supposed to do or what I was saying. But so I was talking, the going back to the reason, most of our income comes from that appreciation side, or most of our profit does. But some of those things also trickle over to the cash flow as well, right? Like I think that you can get some additional cash flow benefits in the same way, as far as like the network effects and like learning what other people are doing, moving over, switching managers, switching strategies, that stuff can affect that too. But I don't know if I stressed enough how much, just like how he showed, so much of, if you're in this game for the long term, I'm a very firm believer in, the vast majority of your profit is going to come from price appreciation. And so that's why, like, having this additional aspect of where we can push price appreciation in several different ways that we can't do when we're buying properties in real life, just makes me that much more bullish on this type of platform. Now, over the last several weeks, it's been really bumpy for Lofty, right? Like that's I really hope we make it through, and that there's the one rogue manager doesn't just pull down the whole platform. But I think it's a really good example of why I'd like to see a similar secondary market form on all of the platforms that are currently doing this. And also maybe just adjust. I don't know what Arc 7 is doing. I really can't figure out why you don't get those same level of discounts. Like, people just somehow, I think that you just at the moment have people that believe in it a little bit more, right? Like, their spirits haven't been crushed when a token goes, or when yields go down. They're not just selling out in the same way that we're seeing. um and like I said, I mean, I think that's kind of a good thing, as far as from the perspective of long-term holders. But it certainly isn't helpful for people that are just really trying to make money on the arbitrage here. So um, that's one I really do go back and forth on. Anyway, if you've made it this far, thank you for watching. If you've been investing for a while, where's most of your money come from? Has it come from yield? Has it come from price appreciation? Oh, what happened there? So my computer just fell asleep because I haven't changed anything. I think that it still recorded that. I don't know what the screen looked like. Hopefully nobody's scared of the dark if it did go black. But I really just want to get some input. If you've been on here for a while, I know there's a lot of yield chasers on here. Is that where most of your return has come from? Has it come from, arbitrage to a real world sale? Has it come from buying at a discount and now, that token prices come back? Yeah, let me know. Feel free to jump in the Discord and talk about it, or just put a comment to this video. I know I screwed up a whole bunch in this video. Sorry about that. It's actually like the fourth time I tried it. I don't know why I had so many problems. I think my computer's trying to do some update in the background, and I didn't catch it until I was doing this, and now I can see the little thing. So sorry about that. Hopefully tomorrow's will be better. That's it. Until next time, I'm gonna keep making mistakes so that you don't have to.